Hey folks, welcome to the final type of adjusting journal entry, accrued expenses. Just to review, adjusting journal entries are made at the end of the period, and they generally have one balance sheet account and one income statement account. Those of you who are accounting majors, once you get to intermediate, there will be one adjusting entry that has two balance sheet accounts. But for everything for Accounting 201 or the principles of accounting, just consider that when you're doing your adjusting journal entries, you can do a reasonableness check and make sure that you have debited a balance sheet account, debited or credited a balance sheet account, and debited or credited an income statement account. Okay, so back to accrued expenses. It is an expense that has been incurred. So you have used or consumed something. You have not paid it and you have not recorded it. So because the expense is incurred, accrual basis accounting tells us that we need to record that expense in the period it was incurred. So the adjusting entry is to get that expense recorded, and because we haven't paid it, we'll make a credit to a liability account. So there is no generic entry, original entry, excuse me. If we do not make our adjusting entry and we do not increase our expense account, then our expenses are understated or too low. If we do not make the adjusting entry and increase our liability, then our liabilities are too low and are understated. So again, both expenses and liabilities are understated. Okay, for our example, you may see homework with 4 different types of accrued expenses: interest expense, rent expense, tax expense, and salary expense. And I'm going to show you an accrued interest example because we need to talk about how you calculate interest at this point. All right, if the company borrows $50,000, not 50, $5,000 on October 1st at an interest rate of 12%. Okay, what this means, the interest rates are given as an annual percentage rate, APR. So the 12% represents interest for a whole year. The adjusting entry needs to record just 1 month of interest on this money that was borrowed. Because we borrowed it October 1, we're going to make an adjusting entry at the end of October, so 1 month interest. The formula for computing interest is principal times rate times time. So our principal amount is $5,000, our rate is 12%, and our time period is 1 month divided by 12 months, and that gets us to $50. So on the last day of the year, we want to record interest expense with a debit, and we want to record our liability because we haven't paid it yet with a credit to interest payable. So this type of adjusting entry will work anytime you are accruing interest, rent, or taxes, or salaries, okay? The salaries can present another little problem. So I want to do an example for that one too. The accrued expenses for salaries. Salaries and wages are usually paid after the employee has done the work, okay? So at the end of an accounting period might be in the middle of a pay period. If you're paid weekly, if you're paid, the new accounting period may come in on a Wednesday of the week. It could come in on a Monday, Tuesday, it could come in any day of the week. If you're paid twice a month, you might be paid on the 15th and the 31st, or you might be paid on the 15th and the 1st. Or you could just be paid every 2 weeks, whatever it happens to be on a Friday. So what we want to do is we want the actual payment for the salaries, the ones that are accrued at the end of the period that haven't been paid yet. The payment is really going to happen next period. But we want those salaries and wages that were incurred this period to be recorded in this period. That's why we have to make the adjusting entry. So let's assume the following. The last payday in October of year 1 was October 26th. Okay, October 27 and 8 are non-working weekend days. So work performed on October 29, 30, and 31, which is Monday, Tuesday, Wednesday, will actually be paid in November. Okay? The total pay per week is $2,000 for a 5-day work week. So the adjusting entry at the end of October is going to record the 3 days of salaries that were earned during October. So it's an expense that the company incurred during October, and we haven't paid it yet, so we need to record the expense and the liability for it. So on October 31, we will debit our expense, which is salary and wage expense. We will credit our liability, which is salary and wages payable. We take our $2,000 for a 5-day work week, multiply it by 3/5, 3 days out of 5 working days, and it will be $1,200 is our entry. Okay, it's all in the reading and comprehension. You have to read the problem carefully, comprehend what it's saying, which may mean put it into words you understand, and then figure out what's happened and make the appropriate journal entry. All right, I want to go back and reiterate one more thing. I said that at the beginning of this video, I said that the typical adjusting entries will have a balance sheet account and an income statement account. So let's go identify those in all 4 types of our entries. For prepaid expense adjusting entries, the expense goes on the income statement. The asset goes on the balance sheet. So that one's covered. For prepaid revenue adjusting entries, remember what kind of an account is unearned revenue? Liability. Okay, so that goes on the balance sheet. Revenue is revenue that goes on the income statement. For accrued revenues, receivables go on which statement? Got it, balance sheet. And revenues are on the income statement. Okay, and then finally, accrued expenses. The expense goes on the income statement, and the liability goes on the balance sheet. So in every adjusting journal entry that we're going to have here in this class, we will have one balance sheet account and one income statement account affected. And that's a good reasonableness check to make sure that you're on the right path. Okay, see you next time. Bye.